Entrepreneurship, wisdom to wealth. Welcome to Entrepreneurship, Wisdom to Wealth. I'm Regina Davis, your host. Welcome to Season 2. Welcome to Wisdom to Wealth. I'm Regina Davis.
I'm Doug Sims.
Tonight we have our guest, Derrick Banks, who is an enrolled agent, trusted tax advisor. Welcome.
Welcome.
So, Mr. Banks actually is originally from Atlanta, Georgia. He has experienced over 35 years experience dealing with tax solutions. And so we just want to hear first what your journey actually is, what made you, what took place in your life to make you decide the field that you're actually in.
Sure. Well, I got into the tax business because my father prepared the taxes in the community. So I decided that I was going to continue with the legacy and become a certified public accountant, but I chose another path. So I took it directly into the field of taxation. I have a niche in taxation, which is called tax resolutions. It elevates yourself from the tax preparer in that we seek out individuals who have tax liabilities and we negotiate settlements, either offering compromises or non-collectible items.
So with that being said, what type of education would you have to go from your standard tax person to being a tax resolution?
Well, the tax industry as it stands now is not regulated as it should be. And it doesn't require any special education. At this point, the only thing you have to do is be able to get what's called a PTIN, and that's it. But as I said, I've been in this for 35 years, and what I chose to do is have a special niche, and again, that being tax resolution.
Okay. So with the, so just off a general tax question, can you explain to our audience what type of taxes come with the S Corp, the corporation, individual? How would one choose to pick one if you wanted to be an entrepreneur?
Great question. Initially, there are 4 types of entities. One being sole proprietorship, where the individual operates either under his name or an assumed name, which is the simplest form of business. Then we come to the limited liability company, which is probably the most favorable entity for most individuals. Limited liabilities can take on different flavors. Either they can be single member LLCs or multiple member LLCs. Single member LLCs are taxed on Schedule C. Multiple members are taxed on a 1065, which is a partnership return. The next entity being corporation, C Corps. C Corps are coming back into vogue now because of the lowering of the corporate taxation. The purpose of an LLC or a flow-through entity is for the profit or loss flows to the individual personal tax return. Currently, corporate tax is at 35%. We expect the new regime to reduce those to 21%. So in most people's cases, they're normally in the 25 and or up tax bracket. So therefore, by converting to a C corporation, you're reducing your tax liability from 35% to 21%, which is a 14% gap.
Okay. Can you explain the difference with the schedule?
Schedules, well, it depended upon what type of entity. As I stated, Schedule Cs are done for sole proprietorships. Let's just kind of break it down. We'll just kind of go A, B, C, D, E, F, G. Schedule A's are prepared in conjunction with a 1040 individual tax return. And on Schedule A, it's used for the itemization of spent expenses, medical expenses, SALT, which is state and local taxes, which is currently being capped at $10,000. This is an item here that's heavily in the news of taxation, and that it rules out a lot of people for the SALT tax. As I stated, Schedule A is for personal itemizations, medical expenses, personal property tax, mortgage interest, and the such. Being with the repeal with the old regime, they ruled out some of or they eliminated some of the deductions. And in elimination of the deductions, they raised the standard deduction. So in essence, it kind of works out, it balances itself. The next schedule, being Schedule B, is used to report interest. Interest received either on non-taxable items or taxable items. And that kind of flows into the Schedule C, which is a schedule that's prepared by sole proprietors. And that's normally the small business, that's normally the initial business that people start out, and they determine if their business warrants them to move up into a higher structured entity, that's what we'll call it. And the purpose is to keep your tax liability to a minimum. There are two things here that I really want to discuss. There's called tax evasion is illegal, tax avoidance is useful. Let me repeat that again. Tax evasion is illegal. Tax avoidance is a tool used to reduce your tax liability. So in essence, to reduce your tax liability, you need to plan in advance. And we're going to go finally with the Schedule D, which is used for capital gains. And for our audience out there who are trading cryptocurrency, that's the schedule that you will use to report your cryptocurrency activities. We'll kind of go back into crypto a little bit later in the program. And finally, Schedule E, which is used for reporting rental income. Rental income takes on various factors as to determining the taxability or whether or not a loss or a gain is allowed. There are various factors in determining whether it's a passive entity or an active entity. Active entities occur when an individual participates 750 hours or more within that particular rental property. And the flip side of that is that either you could be a tax professional, which automatically which automatically allows you to take deduction. And also we have the passive loss. Those are for individuals who have less than 750 hours, and they're using that to net against passive activities that require gain. Finally, we'll go to the Schedule F, that's used in the farming industry. And I think we covered the schedules there, sir.
Okay. That's a lot of good information. Yeah.
So I get a lot of questions, what can you deduct? When should you start saving? How often? How long can your business be in the negative? Where you're not profiting.
Well, in most cases, the Internal Revenue Service allows within 7 years that 3 of those years be profitable, and after the 3rd year, the Service Bureau really wants the business to be profitable. And if it continues with a loss in the 4th year, the Internal Revenue can deem that to be a hobby, in which the income is reported, but deductions are not allowed.
Okay. Yeah.
Speaking of deductions, a lot of entrepreneurs and business people, let's say they buy a brand new computer. Is there a time frame where they can take the deduction? Because I think a lot of people think just because they went out and spent $3,000 on a computer, they can deduct all the $3,000 at one time. Is that incorrect?
That is correct, and actually that's a great question. And with the 2020 changing of the code, Depreciation is now at bonus, and they're allowing 100% deduction. And on the bonus depreciation, depending upon what type of asset is purchased, you can get 200% deduction. Depreciations are an intangible loss. It is determined by the useful life of an asset divided into costs, and there are normally certain depreciation periods, and depending upon the type of assets. And again, with the 2020 passing of the new taxation law, is that depreciation can be used at 100% of the loss or of the gain to offset.
Is there a time frame for that?
Well, it's normally filed within the year in which an asset is purchased or placed into service. Okay. And we'll just kind of go over some of the things. Computers normally have a shelf life or an asset life of 3 years. Furniture and fixture, 5 years. Automobiles, 7 years. And rental property, 27.5 years.
That's a nice time frame for that rental property.
Yes.
So, for an entrepreneur to build, would you advise an entrepreneur to build business credit?
That's a strong question, in that it allows for differentiation between the personal and the business. There are various programs out there that allow people to build business credit. I won't really get into the credit part of it because that's not my area of expertise, but you want to establish a DUNS number, and you want to establish some credit in the business name, and in turn it builds up the business credit.
So what about preparing for retirement?
Another great question. As it's being seen, with the onset of COVID, the government is more interested in people owning their own business, i.e. because the government wants you to be able to sock money away for your own retirement. As we know, the practice of pensions are no longer. So individuals have to fend for themselves. They've got to plan in advance. The sooner the better. In that rule of 72 allows for a compounding of interest. And so it's best to start early so that what you save now will save you later. There are various types of investment vehicles or used for retirement. The simplest form being the IRA. Various types of IRA, the most popular being the Roth IRA. The reason Roth being more popular is that the taxes are paid for up front. And once you reach the ripe age of retirement, which is quote unquote, could be 59 and a half without any penalties, after using the formula of rule of 72, then you can set yourself up for a good retirement.
So, excuse me. So in your profession, you've been in this for 35 plus years?
35, somewhere about.
Okay. So what would you tell those that are interested in getting into your field?
Debits on the left, credits on the right. I decided to get into the accounting field via default. Actually, my father prepared everybody's taxes in the community. And so for my siblings are either engineers or architects or mathematicians. So I come from a family of high achievers. So I thought it to be befitting to follow in the footsteps of my father. I kind of took my own path towards this thing. But it's been very, I've had some great times in doing taxation. So anybody who wants to get into business, let's just say it requires attention to details.
And that hasn't changed at all?
Not at all.
No, because I was actually going to ask that. What were some of the things that were and things that are now? Are things more complicated now?
In a sense, with the advent of tax programs, the turbo taxes and things, it made it easier to prepare a return. However, the comprehension of the return is not there. As it's being seen that there are a lot of errors in those commercial softwares. And it kind of puts pressure on the individuals to know the items that they can deduct or they cannot. As we're seeing now that with the stimulus is being presented, $2 trillion deficits, that the government has to raise taxation in order to pay for those things. And the IRS has sought out to hire 87,000 agents to combat what's called tax gap. Tax gap meaning the IRS has determined what's owed versus what's been collected. And now they're going to get their agents, their 87,000 agents, to go out and collect their taxes.
So speaking of tax collection and things of that nature, all these different programs that's out that you hear on the radio, we can solve your debt reduction and things of that. How credible are those?
A lot of those advertisements are hyperbole. It's basically to get you in and get you wrapped up, and they promise one thing and they do another. Really, nobody can determine what percentage that the IRS will work at. It's based upon an individual basis after preparing a 433 collection schedule, i.e. that meaning presenting your income and your deductible expenses. When I say deductible expenses, the IRS has a national standards that they've placed on their website that allows certain deductions within certain categories, where housing allowance in Michigan may be greater than housing allowance in Georgia, strictly because of the cost of living. But there's a guide, there's a table out there that determines deductible expenses. And from there, the IRS, based upon your income and your expenses or your deductible expenses that they will allow, will determine your ability to pay your tax liabilities. Again, with the onset of COVID, we have a lot of cases where most people can become non-collectible. And what happens in a non-collectible situation is that the IRS deems, yes, you have a liability, but you cannot pay at this time. And on an annual basis, the IRS will go back and assess what's your ability to pay. And from there, they'll determine what and how it's going to be done. So there are tools and mechanisms out there that can be used to your advantage to defray, reduce your liabilities. And I guess one that I didn't touch on was an offering compromise. That means if you owe $100,000, based upon your financial position, the IRS will accept a credible offer to reduce your tax liability. More or less, it's a get out of jail card. It says, okay, we'll reduce your liabilities if you go straight in the next 7 years, and then we'll reduce your liabilities.
Okay, so I guess another question I would have would be, let's say, I know there's a lot of people in America, period, that may not have filed for 3, 4, 5 years or what have you. Would it be best for them to contact the IRS to maybe resolve that situation?
No way. I would say hire a tax professional so that he or she can hold your hand through the process. Contacting the IRS directly by a taxpayer it sometimes can be dangerous. The IRS asks leading questions that you may not be aware of. So it's like going into a courtroom. You wouldn't go into a courtroom without an attorney representation. So I would strongly recommend that you have representation in dealing with the Internal Revenue Service.
You can ask all the questions, actually. Oh, that's good.
So what type of, what nugget or wisdom would you leave with someone that's interested in your particular field?
I would say gather your paperwork with information you have, gather your notices, and contact us, and we will assess your information and tell you what's the best plan of action.
So my actual last question is kind of back to the journey piece of it. So that was a nugget for business, but a nugget for personal. What, someone's just on the journey of working for themselves, being in control of their own schedules, that sort of thing. What sort of advice would you give just an entrepreneur of any industry?
Okay, that's a great question as well. You're either going to save money, sock it away in a retirement, or you're going to pay taxes. By socking your money away in savings, it's a tool used to reduce your tax liability as well. Example, $100,000 in income, $30,000 in a simplified employee pension plan. So now your taxable income is $70,000. $30,000 can be placed in a interest-bearing IRA, a Roth, or a SEP, or a defined pension plan, just depending upon the complexity of that business. And again, it's for money that's going to be used later in life.
So is there, excuse me, is there I'm sure there's information out there on websites or what have you that the general consumer can go down and get all this great information?
The IRS has a plethora of information on their website, www.irs.gov. And as you comb through those things, it enlightens you as to what's there, what you can and cannot do.
Good information.
Yeah, great.
Thank you so much.
You're more than welcome.
We definitely appreciate you coming on to the show and giving up this information. I learned something today.
All the way from Atlanta.
Thank you very much again for allowing me to don your great program.
Thank you.